Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello everyone, my name is Anne Risse and I work as Policy and Communication Officer at Eurosif. For this episode of Sustainability Bridges, I'm very happy to be joined by Dr. Riyong Kim, who is Head of Sustainability at the European Environment Agency, or EEA. Dr. Riyong Kim is a natural resource economist and an expert on tackling sustainability challenges, including the interdependencies between social, economic, and environmental objectives. She has a background in integrating sustainability in financial markets and led the work on finance and overcoming short-termism at the European Institute of Innovation and Technology, Climate Knowledge and Innovation Community in the past. She and her team recently published a very extensive analysis, the EEA's flagship report, Europe's Environment 2025, which takes stock of where the EU is with regards to its sustainability objectives. Today, we'd like to take this opportunity to discuss the progress that has been achieved, the challenges that persist, and what this means for the economy and the financial sector. And then we can take a closer look at how financing, particularly investment in biodiversity, can help make our economy more resilient and sustainable. So welcome and thank you very much.
Thank you so much for having me on the podcast.
So to start, for the listeners who are maybe not so familiar with the European Environment Agency and your report, could you give us some background on your organization and this project?
So just in terms of the European Environment Agency, we're an EU-wide agency which was established in 1993 based in Copenhagen. And we have a network of member states, which is called the European Environment Information and Observation Network, our IONET, which basically draws on expertise from 38 member and cooperating countries. And these countries are all the EU countries, plus several cooperating countries, including Iceland, Liechtenstein, Norway, Switzerland, and the West Balkan states as well. And our mission essentially is to collect and analyze environmental data and monitor trends, and then publish reports and indicators to support policy making and public awareness. And in our mandate actually is the development of a 5-yearly flagship called the State and Outlook of the Environment. And so just back in September, at the end of September, we launched our 7th edition of the State and Outlook of Europe's Environment, which we call now Europe's Environment. And it composes of 3 packed parts, which for this particular edition, it's the main report, which is a narrative on Europe's environment, climate and sustainability, really speaking to the policy priorities of this Commission. And then we have EU-wide thematic briefings, so 35 concise briefings covering trends, outlooks and progress towards EU policy targets across different thematic domains at the EU level. And then for the first time, we've actually then done country profiles, reintroducing them after 10 years again, but this time with indicators on environment and climate and socio-economic systems, as well as systems assessment, to allow us to be able to compare countries' progress along key trends in the environment, climate, and social and economic across all the 38 member and cooperating countries as well. So this is kind of like the most comprehensive effort we've made so far in really reporting on the state and outlook of the environment.
Thank you very much. It really sounds like this great big overview report. Very interesting. And you highlight some major successes of the recent years, but at the same time, you also warn that large parts of Europe's environment are in poor condition and continue to deteriorate. Could you summarize your main findings?
Absolutely. I think if anyone caught the main tagline of our report, it basically stresses that the overall state of Europe's environment is not good. And many of the trends are concerning and they pose major risks for our prosperity, security, quality of life, and also threaten our competitiveness, to be honest. I guess I can make 3 key points. The first is that we are in trouble in terms of nature. We have biodiversity loss of about 81% in terms of habitats, almost 40% in birds, over 60% in non-bird species. They are all in poor or bad state, and the overall condition of terrestrial and freshwater and marine biodiversity is poor and deteriorating. So in terms of nature, we're not doing very good. We also have degraded soils. So this means that the quality of the soils are actually going much further down, especially in the agricultural area, which basically limits our function to support food production. We're experiencing widespread water stress. So we know that 1 in 3 Europeans experience seasonal water scarcity across Europe. And we also have issues with persistent pollution. So nutrient and pesticide runoffs from agriculture, microplastics, persistent chemicals, they threaten our ecosystems, but also threaten eventually our populations. So this is still really, really concerning. On top of this, we have climate change, which amplifies all of these pressures. So the impacts are getting worse from climate change, and they're making some of these other trends even more worse. We can see also a slow progress in transforming certain systems of production and consumption, especially in the mobility system and the food system, which is still very heavily dependent on kind of a very fossil fuel heavy type of source of energy. But I don't want to leave it with just only the bad news, because we have seen reasons for hope. We have seen that Europe has actually made really significant progress in climate mitigation. So EU domestic greenhouse gas emissions are down by 37% since 1990. And this is driven essentially by reduced fossil fuel use relative to 1990, of course, and the doubling of the renewable energy share since 2005, which has then led to air quality improvements to a large extent. We've seen many major air pollutants such as NOx, sulfur dioxide, heavy metals, which have been declining. And just briefly on the protected areas, we can see that the share of protected land rose to 26% and protected seas to 12%. So we're on our way to achieving our protection goals, but on the large, it is a very negative outlook for biodiversity and ecosystems. And a lot of our EU policy targets, such as halting biodiversity loss or achieving good water status, they're probably not going to be met without any kind of accelerated action, unfortunately.
Thank you very much. So yes, alarming, but with some silver linings. And so, as it's probably clear from what you just said, this report covers many aspects of sustainability. But since this podcast mainly focuses on the role of finance, I'd like to dig a bit deeper into the relationship between nature and the economy. You've already mentioned that it's a threat also for our economy or competitiveness. One striking point that I got from reading your report is how much value the environment creates for the European economy, or if you look at it the other way around, how much the economy depends on nature. Could you elaborate a bit on this aspect?
Yeah, absolutely. And I'm really happy that you have gotten that message from our report, because that was a message we really wanted to push forward, that nature is so fundamental to our society and economy that without it, we're actually risking, our future prosperity in essence. So we demonstrated in this report that the environment is not just a backdrop, it's a core source of value. It's a core source of resources, which are largely depended on by a lot of businesses. So we have some figures in our report where 72% of euro area firms in the real economy are relying on at least one ecosystem service. Also, 3/4 of the corporate financing are linked to ecosystem services such as pollination, water purification, and flood control. And the portion of EU gross value added that depends on nature is up to 36% of the total. So we've got figures that actually support and start to quantify just how much we're depending on some ecosystem services and their resources. And maybe just to make it go a level deeper for those who are not that familiar with what we mean by ecosystem services, these are the services that robust, healthy ecosystems provide. For example, things like climate regulation, the carbon that's captured within trees. You will also have things like clean water. So forests have a function of actually purifying our water, also fertilizing our soils. Our biodiversity provides services such as pollination, so the bees and the birds that move from flower to flower allow the pollination services, which are so vital for our agricultural production as well. And all of these ecosystem services underpin the way that we use our nature for food production, for raw materials, these kind of things. They underpin economic activity and our well-being. And a figure from JRC that we have is that we know that these ecosystem services generate 234 billion euros each year, which is comparable to the gross value added of the entire agricultural and forestry sector's contribution to the EU economy. So it is a very large contribution to the economy and often goes unquantified or unseen because these services are, only provided when we actually have very healthy ecosystems. And I guess the point that we're trying to make in the report is essentially that when ecosystems degrade, those same firms that depend on these are going to then start to encounter supply chain shocks, cost spikes because resources are scarce. They'll start facing credit risk pressures, and that's just going to ripple on into the financial system and lead to heightened financial vulnerability. And this risk dimension is already high on the agenda for a lot of central banks, regulators, as well as the insurance sector, as we know. So yeah, in short, nature supplies a really large share of Europe's economic output and basically underpins the stability of the financial sector. So nature and protecting and restoring nature is essential for our prosperity going forward.
So in your report, you also estimate that each year until 2030, we would need an additional 21 billion euros of investment to reach our biodiversity goals. Where specifically is this financing falling short, and where are the main barriers?
Yeah, great question. So the way that we figured this out was that the overall EU biodiversity budget, so the EU needs about 54 billion a year to meet the 2030 biodiversity targets. But the projected allocation for the period of 2021 to 2027 peaks at about 32.8 and falls to 28.5 by 2027, which leaves this annual average shortfall of 21 billion per year. And we some examples here, in particular with nature restoration, where we have the regulation nature restoration, where we have a goal to restore 20% of land and sea by 2030. The public funding for restoration is far below the level required. The EU had aimed to allocate 7.5% of its budget to biodiversity in 24-25 and 10% in 26-27, but the projections show that only 8.5% of that will be reached. So this is really already a gap in restoration financing. And so it's important that with the implementation and the forthcoming national restoration plans that there is some kind of credible financing dimension to this. Also, the funding for the management of protected areas we know are at the lower end of the estimated need, contributing to the overall gap, and also that the private sector mobilisation has just been lacking. Private capital is still limited because very few projects meet the EU taxonomy, which is then our classification system for what is green and what's not. And there's very few biodiversity-specific financial instruments that can actually attract private investment as well. And I just wanted to mention on top of that, as we've seen, the soil monitoring law has just been passed as well, that the European Commission actually estimates that on top of the biodiversity financing we need an additional 17 billion per year for sustainable soil management, which is not covered by current allocations. So there's a really big funding gap that we need to cover that I think is going to be a key problem. And the second part of your question on the barriers, I think there are several barriers here. So I mentioned one before on the limited private capital. I think that one of the issues here has been essentially that a lot of the projects that we have so far don't qualify for taxonomy aligned financing. So this remains really limited. We also have very insufficient public funding just generally. The EU and member state contributions have risen only very modestly, while the annual need has kind of more than doubled. So the rate at which we need financing contra the contributions are just not following suit. And the EU share of the budget is way below the 10% target. So it's really important in this new proposed multi-annual financial framework that we get at least the 10% of the 35% earmarked for climate environment expenditures in order to protect and enhance biodiversity. I think a third key barrier, so the private, the public, the insufficient public, but the third key barrier is the data gaps, the data and monitoring gaps. We do lack, very much unlike the climate system, we lack a reliable and standardized data and metrics for measuring biodiversity outcomes. And they're still in development. There's new innovative ones coming on the market all the time. But this standardization, I think, is the key word here, that how do you compare apples and oranges when you start measuring biodiversity outcomes? And also, how do you start turning that into a real value for the investors and a real return as well? And not only the metrics, but then the data itself on biodiversity financing. I mean, this has been a problem in the biodiversity field just generally, that trying to get a hand on open source biodiversity data that's robust enough to tell us the quality of biodiversity in a particular area, that is really, really lacking. It's very expensive. It requires often on the ground triangulation where you're actually trying to check whether there are certain species densities in a certain area. So it's really, really hard to get, first of all, comprehensive data in order to track that progress and to actually target gaps in biodiversity financing. And it makes it very difficult for the whole MRV, the monitoring, reporting and verification of, for example, if we started with nature credits as a way of financing nature and biodiversity, it relies a lot on these data and the monitoring and the metrics here. So it's very technically challenging, especially for a lot of small projects. The last point I want to make in terms of key barrier is policy incoherence. Where we have a European Green Deal, big policy frameworks that have very ambitious targets. The Green Deal is still in the backdrop and still is, in play, but it's not fully aligned with sectoral policies such as agriculture, forestry, fisheries, energy, that kind of thing. So one example are your harmful subsidies within some of their sectoral policies, 34 to 48 billion euros a year that are going to these subsidies that are not aligned with biodiversity goals. And they basically undermine our biodiversity investment incentives. So this kind of lack of clear, coherent policy goals and standards can actually really deter private investors as well. It's like, what are we actually investing into? So those are probably the four key barriers I can see that are really standing in our way of actually meeting this particular shortfall.
Yes, and I fully agree on the point on data for investors, because when talking to investors in our network, we also have the strong impression that climate data, there is quite a lot of it and you can access it, but biodiversity is very, very challenging often. But you also mention in your report that climate and biodiversity investment are actually two things that can work together very well for investors. Could you explain this further?
Yeah, absolutely. I mean, there are a lot of synergies that we could try, especially when it comes to investments into biodiversity and climate. So climate investments are much more established. And just to your point before, one of the reasons why they are so established is because the metric is easier. You have calculations for how to calculate a ton of CO2 in any kind of organic object almost now, and kind of accepted methodologies to do so, where you just don't have that for biodiversity. So we're going to be facing that challenge as long as we lack a standardized metric for biodiversity, and whether that's feasible to get that or not, let's not speculate on that. But yeah, so investors are more familiar with climate-related finance, for example, emissions allowances under the emissions trading schemes, rather than other types of biodiversity investments. So there's a synergy here that we could try and take advantage of. So just on the outset, first of all, the funding gap's similar. Biodiversity faces similar annual investment gaps to climate adaptation, and both are going to actually rely on private capital to close them. So if we started bundling climate and biodiversity projects, then investors can actually tap larger pools of publicly funded green or nature positive financing and improve basically the economics of each individual projects. The two key synergies probably revolve around, first of all, co-benefits and shared risk reduction between climate and biodiversity projects. So what I mean here is that often when you're investing into biodiversity, you will also get co-benefits for climate. So if we are starting to plant forests for biodiversity, they're also going to have climate functions such as capturing carbon, such as regulating climate and making it cooler, for example, like urban green spaces and things like that. So there are co-benefits for climate goals and climate adaptation as well as mitigation goals. So this means that essentially a single investment into a nature-based solution can contribute both to climate targets in the EU and the EU biodiversity strategy. So you can have the same capital being used twice, essentially. Then from more of an investor view, I mean, you have shared risk reduction. So I guess from an investor view, you want to kind of diversify your risk. So when you're investing into a portfolio, you want to make sure that not only everything that you put in is basically going to disappear the next day. So by actually combining biodiversity, and because they're so interconnected with each other, you are actually reducing risk, and you're spreading that. You're rewarding this multifunctional ecosystem outcomes, so to speak. Protecting ecosystems will lower exposure to climate-related losses. So you're sharing the risk reduction benefits here. And that's why, so investors in essence can actually lower the volatility or the risk that they have in their portfolio by allocating to projects that deliver on both goals, climate and biodiversity. And one example, which is maybe easier to understand, is like restoring wetlands. Wetlands are a highly biodiverse ecosystem, but they also store carbon and they can also reduce flood risk. So you have two goals at the same time, and we can actually work towards that. The second key synergy I can see is this idea that investors in particular can, the two birds with one stone, which is not very eco-friendly, but feeding two birds with one seed, I think, is a more eco-friendly term, because we have a lot of policy instruments that actually aim to both objectives. So the EU taxonomy, the EU Green Bond Standard, the carbon removal certification framework, these are all ways to redirect capital flows to sustainable activities that include both climate and nature. So investors, in essence, will be, it will help them comply with some of these reporting obligations when they start investing in both climate and biodiversity. And same with other directives, for example, the Corporate Sustainability Reporting Directive and the European Sustainability Reporting Standards. These are regulations that require companies to disclose both climate and nature-related risks and enable investors, regulators to assess combined exposure. So this, again, will help companies actually report on both of these objectives, essentially. And then in the end, you might even expect that the ESG ratings of those companies will also be bumped up because you're serving both objectives. So there are key synergies here, especially around those two big areas that I think are ways in which they can work together for investors, and it's just a really good choice as well.
Yes, absolutely. We also work a lot on CSRD and ESRS and think it's very crucial, especially also to have those biodiversity and nature-related disclosures in there, especially because it's hard to get them otherwise. What's also your take on maybe the role that other frameworks, like voluntary frameworks, such as the Task Force on Nature-related Financial Disclosures, can play? And what would be the impact of some of the current simplification initiatives, like the Omnibus One package, which proposes to reduce some of the reporting requirements of the CSRD, among others, on the availability of such data?
Yeah, voluntary frameworks such as the Task Force on Nature-related Financial Disclosures, they're really, really promising. In all of my experience, also in my previous function at Climate Kick in the decision making finance, we could definitely see these voluntary frameworks were a lot further along in the thinking in terms of creating consistent and comparable reporting standards. But the problem is they're voluntary. And especially with the TNFD, these are still quite peripheral and still quite experimental. And until they're more tightly linked to EU reporting requirements, the uptake will be very limited and the data not widely available either. So there is this element of the fact that it is voluntary that limits its use, and it kind of then amplifies the fact that it's not taken up, and then it kind of goes into this circle, right? So I think there's this link to this EU reporting requirements that if we really are to succeed with things like TNFD, that we need to get them very much plugged in. And so then on the omnibus, I think the interesting thing here is that we've heard a lot about this. We know that the simplification risks curtailing some of the data flows. And this will also then potentially limit investors and regulators' ability to assess nature-related risks and channel finance towards biodiversity projects. But what we know so far is the process is ongoing and the trilogues haven't even started, so it's probably not very easy to speculate about the exact impact. But what the proposals look at is intending that it will intend to reduce the scope of the CSRD by about 80%, so focusing only on the largest entities and limiting the amount of information by companies that the companies or banks can request from smaller suppliers. And the effect that we potentially could see is that in the very short term, it creates risks and uncertainty for companies and market actors. By limiting, data collection only to the large firms, we could also weaken the overall data pool for investors, banks, and regulators that they need for the nature-related risk assessments, and less granular biodiversity data as well, because then fewer firms and data points will actually even be disclosed. So the whole spread, both quality and quantity-wise, will be weakened if this goes through as it is. And then, of course, it will slow then integration of some of these voluntary standards, such as TNFD, because the regulatory baseline that is reported against becomes narrower and narrower. So it reduces the incentive for smaller firms to adopt additional nature disclosure frameworks. So it makes it harder for some of these maybe more innovative voluntary frameworks to kind of break through and become a bit of a standard in the market. But, I've been in a lot of conversations about this omnibus, not lately in amongst the sustainability fashion firms. And a lot of these ambitious companies are also stating that they'll continue to report regardless of what comes out of the omnibus, just due to client demands and the investments that are already being made. So there's a large push. Again, it's the private sector really pushing and leading the way for some of this ambition as well, which is really, really positive to see. But yeah, let's wait and see what the omnibus turns out to be in the very end.
Yes, and as you mentioned, there's also this factor of the uncertainty. So, for example, we've recently done a joint statement with nearly 500 investors, businesses, trade associations, and so on, about the value of sustainable finance rules for the European competitiveness. And for many of the signatories, it is also about having prepared for those rules, seeing their value, and now not wanting to have them rolled back. And maybe to move to another aspect of the EU Sustainable Finance Framework, which you've already mentioned, is the EU taxonomy. So as you said, it defines which economic activities can count as environmentally sustainable. And this also includes biodiversity as a potential objective. But you have already mentioned that many don't meet the requirements of the EU taxonomy. So what's your assessment? Would you say this helped companies address the topic of biodiversity?
Yeah, I mean, I think let's just look at the taxonomy as a whole and the attempt to put the taxonomy in place and congratulate ourselves that we've gotten this far. So that we have some kind of system that looks at what is sustainable or not. That's kind of, a core element of the way that we define, what is sustainable, what's not, sustainable finance and what's not. I think that being said, the taxonomy has become this core element of the EU Sustainable Finance Framework. So not only the taxonomy per se, but the Green Bond Standard, the CSRD, the Sustainable Financial Disclosure Regulation, SFDR. So these are all this package to push companies to report on and invest in activities that meet this biodiversity and climate objectives, for that matter. But the uptake of that is really limited. So only a small proportion of green lending fully complies with the taxonomy, and only a few companies actually currently report under it. So I think the taxonomy has done very well to help raise awareness and provide a common language, but many firms have really yet to fully integrate at least the biodiversity element into their strategies. So there's a lot more to be done, and I think things like also the future omnibus discussion, that really then starts to confuse the waters, especially for those who are not in this EU policy making landscape of sustainable finance. So yeah, there's more to be done here for sure.
Yes, and maybe also an argument for letting the regulation be implemented and develop for a bit before rushing to change it. So as we're coming to the end of this podcast, would you like to share one final point for the investors or companies listening based on your analysis of the lessons learned from recent years of sustainability policies?
Yeah, I mean, there's a lot of things I wanted to say here. One being, well, from a policy objective, it's about policy coherence. So that's maybe more for the policy audience that's listening. But if I was to actually speak to the investors and companies listening, I think one of the biggest problems that we will face with financing biodiversity in the future is becoming or coming to an agreement about what the value of nature actually is. And this is something I've been maybe going on about for many, many years, also because of my background. And we're going to struggle in this because we don't have a single metric and it's not as easy to quantify. So this is where I think investors have an opportunity and companies have an opportunity to be a lot bolder and more innovative on how we define return, and maybe not just rely solely on financial metrics, because we will keep overlooking the long-term value of the investments into biodiversity, the long-term value for future generations, the long-term value for the environment, for our society and well-being and all the rest of it. So I think the next phase really for investors and companies is essentially expanding on new types of thinking in terms of these metrics, and making sure that some of these innovations are also then scaled up and brought out as a standardized market standard, essentially, so that we can all agree on what good return on a biodiversity investment might actually look like. And we've got some good examples already that people have been pioneering. This biodiversity intactness index. This measures the health of ecosystems by assessing how much of the original biodiversity remains. You've got some more specific on, like, for example, soil and water health. So the soil health index, which measures soil organic carbon, structure, microbial activities, which are key indicators of long-term ecosystem productivity. Or the water dependency and resilience index as well, which is the organization's reliance on and contribution to a local water system. So there are indexes out there that can be used and can be tested that will hopefully provide an alternative to the metrics. I think another one that I'm really quite keen on is intergenerational value metrics. So how do we start using these metrics that enhance or deplete the future well-being of future generations? So whilst these metrics don't necessarily replace financial metrics, they can be used in I guess, simultaneous with these and strengthen them by actually revealing what value they actually have, that investors and companies actually have in their assets and their portfolios. And eventually, hopefully, we'll get to a point where, with enough development on these metrics, with enough data on these metrics as well, that we can start redefining what different services, ecosystem resources, the value of nature, what that actually then truly means in terms of value for investors, and define and set future standards for that. And I think this is a really, really big area that will only continue to grow. Most people don't want to touch it because it's so complex and all the rest of it, but I think we need to start, and we've seen some really great innovations up to this point. So my call out would be keep on moving, and then, we'll get there eventually. So that's what I think would be my key message.
Thank you. I think that's a very inspiring ending. And so overall, I think this was a very interesting conversation about how we can protect our nature and use finance to protect it. What I've taken away is that you need both public and private finance. You need the right policy framework, a coherent policy framework that enables this. You need to close data gaps so you know what you should actually invest in or what the state of things is. And lastly, that you should rethink how you define value, the value of nature, or also the value of finance. So many thanks for joining us today. This was really great.
Yeah, thank you so much. Thanks for having me. That was really fun.